In just 48 hours, roughly $6.6 trillion in U.S. stock market value evaporated. Not in months, not in weeks. In 2 trading sessions, April 3rd and April 4th, 2025, a tariff shock hit the tape, bids pulled back, and the largest 2-day wipeout on record printed across screens. The VIX closed at 45.31 on April 4th, a level that screams stress, forced hedging, and thin liquidity. And then something even stranger happened. Days later, on April 9th, the market staged a reversal so violent it looked like the crisis had been rewound. The S&P 500 jumped 9.5% in a single day. The Nasdaq surged 12.2%. The Dow added 7.8%. They said moves like that belong to once-in-a-generation moments, not to a normal policy headline. Yet it happened. Fast, clean, as if the system had found a hidden trapdoor that could release trillions back into price. Here is the pattern interrupt. Fundamentals do not change that quickly. Supply chains do not rebuild overnight. Corporate cash flows do not teleport higher in 48 hours. But prices can. Because the marginal price is not set by the average investor, it is set by the last buyer and the last seller, standing in the moment liquidity gets scarce. When liquidity returns, even briefly, the same mechanism can snap prices higher with astonishing speed. That is why today's story is not really about tariffs. It is not even about whether a policy was good or bad. It is about the liquidity leak nobody talks about, the plumbing beneath headlines that decides when markets crash, when they rebound, and why the rebound can feel like a miracle while the system underneath is still under strain. Welcome to Liquidity Lens, where we decode what matters before it becomes a tidy talking point. If you like calm, forensic breakdowns that connect the boring infrastructure to the dramatic chart, consider sticking around. And drop a comment with where you're watching from, because the one thing that markets always reveal is that this is global, not local. Now let's reconstruct the event with a timeline, because timelines expose mechanisms. On April 3rd, 2025, markets absorbed a sudden escalation in tariff expectations. Liquidity was already thinner than most people realized. Because dealers were managing risk tightly, volatility was rising, and positioning had become crowded. Once the tape turned, selling accelerated. On April 4th, the second leg arrived, and the cumulative loss reached about $6.6 trillion in U.S. equity market value across those 2 sessions. That number is so large it becomes abstract, so anchor it. 6.6 trillion is bigger than the annual economic output of many major countries. It's the kind of number that makes people assume there must have been a massive fundamental collapse behind it. But the key is that the move was compressed into a window where forced activity dominates. When volatility rises, mechanical selling rises. When mechanical selling rises, liquidity providers step back. When liquidity providers step back, price gaps. Then, on April 9th, the headline changed. A 90-day pause on certain tariff measures was announced. It detonated upward. S&P up 9.5%. Nasdaq up 12.2%. That is not a normal rebalancing. That is a positioning unwind plus a liquidity release plus a volatility feedback loop in reverse. Here's where it gets interesting. When you see a crash and a rebound of that magnitude within days, it often signals that the system is not simply reacting to information. It is reacting to constraints. The constraints live in funding markets, collateral markets, and volatility hedging flows. They live in the places most people never look because the charts are not as glamorous as tech stocks. So what is the liquidity leak? Think of liquidity like water pressure in a city. Everyone sees the fountain in the plaza, which is the stock index. But the pressure is set by pumps, reservoirs, and valves that sit underground. When a valve closes, the fountain sputters. When a valve opens, the fountain surges. The plaza crowd argues about the fountain's beauty, but the engineers are down in the tunnels, listening for the hiss that says pressure is escaping somewhere else. In modern markets, one of the biggest valves is short-term rates and the plumbing around them. The Federal Reserve maintains facilities that set boundary conditions for money markets. In late January 2026, for example, the Fed listed an overnight reverse repo offering rate of 3.5% and a standing repo facility at 3.75%, with a per-counterparty daily limit of $160 billion for the overnight reverse repo. Those are not flashy numbers, but they define the floor and the backstop for short-term cash. Another key reservoir is the Treasury General account, which is essentially the government's checking account at the Fed. When that balance rises, cash can be pulled out of the banking system and parked at the Fed. When it falls, cash can flow back. The Fed has repeatedly noted that swings in that account affect reserves and the size and composition of the Fed's balance sheet. And then there is the overnight reverse repo facility itself, often called RRP. In previous cycles, RRP usage surged into the trillions, acting as a sponge that absorbed cash from money market funds. In early February 2026, usage was around $10.415 billion, tiny compared to the peaks of prior years. The contrast matters because it raises a question. If the cash is not sitting in RRP, where is it? And how quickly can it reappear in risk assets when the narrative flips? To see why this matters, we need the hidden pattern, because this is not the first time markets have staged a too-fast recovery. In 2008, a liquidity crisis turned into a cascade as funding markets froze, forcing deleveraging. Then policy signals, liquidity injections, and guarantees created violent counter-rallies inside a larger drawdown. The key lesson was that price can rebound before the system heals because price responds to marginal liquidity first. In 2020, the playbook repeated with different headlines. A sudden shock produced a waterfall sell-off. Then emergency facilities, massive policy response, and balance sheet expansion drove one of the fastest recoveries ever recorded. Again, fundamentals did not normalize overnight. Liquidity did. In 2023, a smaller but instructive version played out when stress in certain banks caused funding concerns and swift repricing. Market narratives flipped daily. Yet beneath the surface, the same forces dominated: collateral preference, reserve distribution, and the willingness of dealers to intermediate risk. Now, in 2025, the pattern shows up again. A policy shock hits, volatility spikes, forced hedging and deleveraging appear, then a policy signal arrives, and the system snaps back. It looks like magic, but it is mechanics. To understand the players, we have to name them, not as villains, but as roles. You have dealers and market makers whose job is to intermediate risk, but whose balance sheets are finite. You have hedge funds, many of which run systematic strategies that adjust exposure based on volatility and trend. You have commodity trading advisors and risk parity frameworks that can reduce equities when volatility rises. You have options market dynamics where gamma exposure can flip from stabilizing to destabilizing in a matter of hours. On April 3rd and 4th, when the selling hit, these roles mattered. As volatility rose, strategies that target volatility reduced exposure. That selling created more volatility. Dealers hedging options exposure may have had to sell into weakness to remain neutral. At the same time, risk limits tighten when the VIX is printing in the mid-40s. If you are providing liquidity, you widen spreads or step back. Then April 9th arrives and the roles reverse. A policy pause headline reduces perceived tail risk. Volatility expectations drop. Strategies that had de-risked begin to re-risk. Dealer hedging flows can turn into buying rather than selling. Shorts cover, put protection becomes less urgent. The same feedback loop that accelerated the fall can accelerate the rise. But if that were the whole story, it would just be a tale of sentiment. The deeper contradiction is that equity recovery can print while the underlying liquidity plumbing is still dealing with constraints. And that is where dislocation shows up, the part no one is discussing. Dislocation means two data sources tell opposite stories. On the screen, the index says the crisis is over because prices jumped. Under the screen, money markets might still be signaling that collateral is prized. Reserves are unevenly distributed, and liquidity is being rerouted rather than freely expanding. You can see hints in how quickly volatility can reappear, how sensitive markets remain to single headlines, and how persistent the demand for safe, short-term parking can be. This is the evidence phase, so let's stack the receipts. Receipt 1, the two-day equity value loss, about $6.6 trillion, April 3rd and 4th, 2025. Receipt 2, the VIX closed at 45.31 on April 4th. Receipt 3, the April 9th rebound, S&P up 9.5%, NASDAQ up 12.2%, Dow up 7.8%. Receipt 4, the Fed's own stated boundary conditions in early 2026, overnight reverse. Repo offered at 3.5%, standing repo at 3.75%, and a $160 billion per counterparty daily cap in the overnight reverse repo facility. Receipt 5, early February 2026, RRP usage around $10.415 billion. A small number that highlights that liquidity can be somewhere without being eager to take risk. These numbers do not predict anything by themselves, but together they show a system where marginal liquidity and positioning can dominate price in compressed time. Now let's explain the mechanism in plain terms. Imagine a crowded theater with one narrow exit. As long as everyone is calm, the exit works fine, but if smoke appears, even if it is small, people rush and the exit becomes a bottleneck. The bottleneck is not the smoke. It is the exit. In markets, the exit width is liquidity and balance sheet capacity. When fear rises, everyone tries to reduce risk at once. The bid side is not infinite. Prices drop rapidly because the system is clearing through a narrow doorway. Policy headlines can change the perceived smoke level. When the announcement on April 9th suggested a 90-day pause, the crowd stopped pushing. Some even rushed back inside to grab the seats they abandoned. But the exit did not suddenly become wider. The structure stayed the same. That is why the market can rebound even while the system remains fragile. The same narrow exit can create violent moves in both directions. In practical terms, this execution chain often involves margin and collateral dynamics. When volatility spikes, margin requirements can rise. When margin rises, leveraged players must post more collateral or reduce positions. To raise cash, they sell what they can, not always what they want. That selling pushes prices down, which can trigger more margin calls, which triggers more selling. Then, when volatility falls and margin pressure eases, the forced selling stops, buying can return, and short covering can ignite. Meanwhile, cash does not disappear. It relocates. It might park in money market funds. It might flow into short-dated treasuries. It might sit as excess reserves in some banks while other banks feel tight. It might choose a facility like the reverse repo, depending on rate and availability. That relocation is the leak. Liquidity leaving the parts of the system that support risk-taking and pooling in places that feel safe. So what does this mean going forward? Historically, when you see a crash and rebound driven by liquidity and positioning rather than slow fundamental change, you often get aftershocks, not because the rebound was fake, but because the underlying constraints are still present. The system is sensitive. It can swing on marginal changes in funding conditions, policy communication, and volatility regimes. There are three broad scenarios that history suggests without making a prediction. In a conservative scenario, liquidity conditions stabilize, volatility gradually compresses, and markets grind, but remain headline sensitive. In a moderate scenario, repeated policy uncertainty triggers periodic spikes, causing sharp pullbacks and sharp rebounds as positioning repeatedly resets. In a more aggressive scenario, a larger funding or collateral dislocation appears, forcing a deeper deleveraging cycle before a cleaner, more durable stabilization. What would you watch? Not as a trade, but as a diagnostic. You would watch short-term funding stress indicators. You would watch volatility behavior after headlines, whether VIX mean reverts quickly or stays elevated. You would watch whether cash continues to prefer safe parking over risk intermediation. You would watch the rhythm of Treasury issuance and the Treasury general account swings, because those flows alter reserve distribution. And you would watch how quickly markets react to small policy phrases, because hypersensitivity is a sign the plumbing is still tight. This brings us to the divide. The difference between those who get blindsided and those who stay oriented is not intelligence. It is attention to plumbing. Most people watch price and narrative. Institutions watch constraints and flows. They watch where cash can earn 3.5% overnight, where collateral is scarce, where repo backstops sit, and where volatility exposure forces mechanical buying or selling. That information gap becomes a wealth gap over time. Not because anyone is evil, but because the system rewards those who understand how it actually clears. Retail often arrives after the move, because retail is watching the headline that just got written. Institutions are positioned around the plumbing that made the headline possible. The $6.6 trillion wipeout and the stunning April 9th rebound are not a one-off story. They are a case study. The data shows a market where price can travel faster than explanation, where liquidity can leak out of risk assets and then rush back in when a valve turns, and where the most important action happens in places most people never look. To make the institutional movement visible, look at what has to happen behind the curtain when volatility jumps into the 40s. Banks and dealers that intermediate risk finance inventories in repo markets and manage balance sheets that are not infinite. When stress rises, they widen spreads, reduce inventory appetite, and push risk back into the crowd. Clearinghouses and exchanges also tighten risk controls. Margin is not a static fee. It responds to realized and implied volatility. If margin requirements rise, even a little, it can force the sale of positions purely to meet collateral demands. Options amplify this. When panic protection is bought, dealers hedging that exposure may sell the underlying, adding pressure into weakness. When the fear premium comes out after a relief headline, those hedges can flip into buying, and short covering accelerates the move. That is why a 9.5% day on the S&P 500 and a 12.2% day on the NASDAQ can happen without any overnight transformation in earnings. The flow changes first, and the story catches up later. Now, zoom out to the historical pattern. In 2008, big up days appeared in the middle of crisis because forced selling paused and policy backstops changed funding expectations. In 2020, the fastest recoveries followed emergency facilities and balance sheet expansion, even while real-world damage was still unfolding. So where is the liquidity leak? It is the tendency for cash to retreat into short-term safe channels when uncertainty rises, draining risk intermediation. One channel is the Treasury bill complex, another is bank reserve buffers, another can be the overnight reverse repo facility, depending on its rate and accessibility. Even when reverse repo usage is small, like roughly $10.415 billion in early February 2026, that does not mean liquidity is abundant everywhere. It means that particular parking lot is not full and cash may be waiting somewhere else. Treasury and Fed operations influence this willingness. The Treasury general account swings can pull cash out of banks and park it at the Fed, changing reserve levels. The Fed itself has pointed out that these fluctuations affect reserves in its balance sheet. Add quantitative tightening or heavy issuance cycles, and liquidity can feel unevenly distributed, calm in one corner, tight in another. That unevenness is exactly what creates dislocations. Here is the dislocation in plain language. On the screen, equities can recover in a day. But in the plumbing, the price of safe overnight, liquidity can still be attractive enough that cash prefers to wait. When the Fed's floor and backstop rates sit around 3.5% and 3.75%, that is a real gravitational pull. If risk assets need to offer a premium to compete, and headlines keep injecting uncertainty, the system toggles between two states, cash hiding, then cash rushing. None of this is conspiracy. It is constraints. It is how a modern market clears when leverage, derivatives, and balance sheet limits meet a sudden policy shock. The April 3rd and 4th wipeout and the April 9th surge are a case study in a simple rule. Price travels at the speed of liquidity, not at the speed of economics. Once you see that, the next big move becomes less mysterious because you know where to listen. Not to the loudest headline, but to the quiet plumbing that decides how wide the exit is. What you watch next is less about direction and more about fragility. When volatility spikes, ask whether it collapses back quickly or stays sticky. A VIX print in the 40s that fades in days suggests forced flows were the driver. A VIX that refuses to normalize suggests funding and collateral stress is lingering. Watch how indexes behave around major option strikes, because that is where hedging flows can change sign. Watch breadth, because a rebound led by a handful of high beta names often says liquidity returned, first to the fastest vehicles. Also watch the calendar. Major Treasury settlements, coupon auctions, and tax dates can shift cash balances in ways that are invisible if you only stare at equities. When the government absorbs cash, reserves can shrink. When it spends, reserves can expand. Those swings do not need to be massive to matter at the margin when dealers are already cautious. And watch how fast policy headlines move markets. When a single phrase produces a multi-trillion-dollar repricing, it is a sign that positioning is crowded and liquidity is doing the real work. If there is a takeaway, it is that the recovery in 48 hours is not proof that nothing happened. It is proof that something structural is happening repeatedly. Liquidity is being redistributed, then remobilized, faster than most narratives can keep up. That is why institutions appear early. They are not guessing. They are reacting to constraints that retail rarely sees. And that is why the public arrives late. The public is waiting for certainty that never appears, because markets move first and explanations follow. Plumbing does not care about opinions. It cares about collateral, cash, and willingness to make markets today. This is Liquidity Lens, where we decode what matters before its headlines. If this connected dots you hadn't seen, you know what to do. Because the question isn't whether markets will swing again. The question is whether you will recognize the plumbing signal before the screen tells a different story.